The United States and China have been meeting to hopefully come to an agreement when it comes to tariffs. And the whole world is watching and holding their breath because this agreement can change the stock market, it can change inflation, and it can impact multiple industries in our economy. Let me explain. Let's start by talking about trucking. Trucking has been in a recession since before tariffs started in 2025. And the reason why goes back to COVID. When COVID happened, the trucking industry was booming like never before. Businesses had things they wanted to sell because everybody was buying everything left and right, and they needed to get these products into their warehouses and stores, meaning they needed truck drivers, they needed trucking businesses, and there wasn't enough. So the pay for truck drivers and trucking businesses went through the roof, which brought in a whole new array of people who wanted to be a truck driver or start a trucking business, which was great in the short term. But then we had this huge oversaturation of truck drivers and trucking businesses, which created a problem for the truck drivers and trucking businesses because now they're all competing against one another, which meant now Walmart can say, we have so many truck drivers to choose from, who wants to do it for the cheapest price possible? So now the prices of truck driving, trucking businesses started to go down, which started to hurt the businesses. Not to mention now, number two, many of these businesses were operating on debt. Debt costs are going up, which meant not only are you making less money, your expenses are also higher because of the more expensive debt. And now we have the perfect storm with the third part, the tariffs. Tariffs meant less goods were coming into the United States. If less goods are coming into the United States, that's less stuff that has to be shipped from one place to the other, which meant less work for truck drivers. Not to mention the fact that people are buying way less stuff now than they were in 2020 and 2021 when there was so much free money floating around. When we had the stimulus money, the unemployment checks, when you had the PPP loans, when you had all that free money, people were spending money and shopping like crazy, which meant more goods were being transported. But when people are now being more pickier with their budgets, people are spending less money, which meant less things are being shipped, which means less money going to the trucking companies. This has been hurting the trucking industry. And of course, trucking is one of those industries that's kind of like the backbone for the United States, which is why trucking is paying attention to what's going on between the United States and China, because with the trade wars, less money goes into trucking. And let's also talk about retailers, because retailers have been on the news recently because they're hoping for a big surge once there is a conclusion when it comes to tariffs. Let me read you this quote. It says, quote, "Many retailers who halted or reduced orders due to tariffs rising to 145%, because remember, the original Chinese tariffs were more than 100%, and are now resuming imports following a reduction to 30% because the Chinese imports have been given a little bit of a grace period and a 90-day tariff pause." So you have a lot of retailers that are now hoping that come July 8th, which is when the next tariff decision is going to be, a lot of these tariffs are going to be gone. The Chinese tariffs are going to be reduced. So we retailers will be able to buy a lot of stuff from China and foreign countries again, hoping that we're going to see a big surge. But there's a little problem here that I want you to also understand. Now, again, we cover all of this in Market Briefs. Market Briefs is my free financial newsletter for investors, where every day my team is working to break down what's happening in things like the economy, stocks, housing, crypto, and the global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read Market Briefs every morning. Plus, when you sign up for Market Briefs, you'll also get my investing masterclass as a bonus for free, where I'll show you how you can start investing and find hidden investment opportunities before everybody else. So if you want to join Market Briefs and get my investing masterclass all for free, all you have to do is click the link down in the description below. Now, let's talk about the problem here. Because what we're seeing happen is a lot of Americans are, for lack of a better word, running out of money. We are seeing right now credit card delinquencies at some of the highest levels since around the 2008 Great Financial Crisis. Why? Well, part of this has to do with inflation. Now, there's a lot of talk about inflation potentially coming back with tariffs, but what we know is over the last 5 years, inflation has been a problem for a lot of people, and for the average American, your income did not keep up with inflation. Now, for some people, yes, incomes went up way faster, but for the average American, incomes did not keep up with inflation, which means you're paying a bigger percentage of your paycheck on your mortgage or your rent. You're paying a bigger percentage of your paycheck on your groceries. You're paying a bigger percentage of your paycheck on your vacations, on your car, on your regular stuff, which means you have less money left over to save and invest, if any. And this is one of the reasons why many people started turning to things like credit cards. We've seen the explosion of buy now, pay later, or as I like to call it, broke now, poor later. And a lot of people have been turning to things like payday loans just to make ends meet. So now, on one hand, we have retailers saying we can't wait for these tariff deals to be done because we're expecting a surge in business. And then on the other hand, we have a lot of Americans that are starting to struggle, which is why I keep going back to this. We're starting to see really this tale of two Americans. You have the investing class that's becoming wealthier. We've seen investment values surge because of inflation. Financially savvy Americans are becoming richer, period. The asset owners are becoming richer, period. Everybody else is struggling more. Rents are still expensive. Housing is still expensive. Are housing prices cooling down? Yes, in some areas we're starting to see it finally cool down, but for the average person, it's still way more expensive than what it was. Car prices are still crazy expensive. Grocery prices are still crazy expensive. I mean, life is expensive. While incomes are not growing right now, and they haven't grown that much since the pandemic to justify all these higher prices. And this is that dilemma. How much more can people squeeze, especially when people are already relying on debt and going deeper into debt? There's going to be a limit to how much somebody can spend on their own debt. It's not the United States government that can just keep extending their debt ceiling. Americans have a limit to how much debt they can borrow. And then, of course, you have a concern of inflation, because if tariffs do continue, a lot of people have talked about how it could create more inflation, a price growth of things. Even President Trump recently talked about this, that if we do see inflation through tariffs, then the Federal Reserve Bank could just raise interest rates at that time. Now, he was saying this because President Trump was telling Jerome Powell, who was a chairman at the Federal Reserve Bank, to cut interest rates. And then if we see inflation due to tariffs, you should raise interest rates then. That was the whole context of things. But we don't know what's going to happen with inflation, which is another reason why interest rates have also stayed higher for longer. Now, why does interest rates matter? Because these interest rates impact how much money you pay to buy a house through a mortgage. It can impact your car loan rate, and it can also impact businesses. Deutsche Bank is now talking about how more businesses will go bankrupt because of the higher interest rates. Let me read you a quote directly from Yahoo Finance about Deutsche Bank. It says, quote, "The rate at which riskier U.S. companies default will increase next year." That's 2026. Deutsche Bank said because of a weakening economic growth and/or the pressure of higher interest payments. So what does all this mean? If we continue to see these tariffs and higher interest rates, it's going to continue to slow down the economy. A slowdown of the economy means people spend less money, which means people are spending less money in businesses. Businesses make smaller revenues. Well, when you couple that with the fact that many businesses are now paying higher interest rates on their debt, because obviously interest rates have stayed higher for longer. Not many people expected interest rates to stay this high for this long. Many businesses have readjusting debts, which means they took out a bunch of debt in 2020 and 2021 at super low interest rates. And now here we are in 2025, and we're starting to see more of that debt start to readjust. We're going to see more debt readjust in 2026. And if interest rates don't drop significantly, that means more and more businesses are going to be forced to pay higher interest payments on those debts. Now, normally that's not a problem, assuming that you can make more money. But it's a lot harder to make more money during a time where either A, the economy is slowing, or B, inflation is a problem because people don't have the ability to keep spending. So this is that conundrum that a lot of people and economists are looking at, that, hey, if we can't solve this trade situation, well, that's going to create a problem because number one, it can make things more expensive. And number two, it can slow down the economy during a time where we're already worried about a slowing economy. And then couple that with the fact that interest rates could stay higher for longer, it can make some things more difficult. Now, this is where you got to understand the full picture. All of this can sound scary. All of this can sound bad. We don't know what's going to happen tomorrow. But what I want you to think about is, where is the opportunity? The question that Wall Street is always asking is, where is the money moving? And that's the question I want you to think about. Because we know that a lot of trucking industries have been hurt. Could it also create an opportunity? Because we know that trucking is probably not going to go away in the next 5 years. Could that create an opportunity? We also know that, well, there's a chance that we'll see a lot of volatility come the first and second week of July when we see the next round of tariff changes. Maybe tariffs will be hotter than expected. Maybe they'll be better than expected. We really have no idea, but it could create an opportunity. We know that there's a lot of changes that are going to happen in the economy. We know that there's a lot of inflation that could potentially happen. Could that create an opportunity? That's the way that I want you to think. I want you to think like an investor instead of getting caught up in the emotion. Are there changes happening? Absolutely. Are there potential pain coming in the future? Absolutely. But you want to be prepared for no matter what's happening. That way you can capitalize on opportunities instead of being the person that's constantly paying the price. And the way you do that is by, number one, not spending all of your money. Have money to save, have money to invest. Number two, start investing in your education as an investor. Maybe this means investing in your own financial education, learning how to invest. Maybe this means investing in your own research, that way you know what to invest in. You have to start putting some of your time and money to work. And then number three, when you see the opportunities that fit within your strategy, execute. I mean, you can get caught up in the emotion and analyze all day and night long, but you got to be willing to actually make an investment. Now, of course, I'm just a random guy on YouTube. Investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And with that, I will see you on YouTube tomorrow.